Well, hey there, everyone. Happy Monday, August 3rd. Happy August. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an increasingly smoky Redmond, Washington. Got wildfires in this part of the country. They're getting worse and worse. Eastern Washington, which is Spokane, which is quite far away from here, has been ravaged by wildfires. Unfortunately, we've been relatively free of the wildfire experience so far, but it's getting smokier today, and the next couple of days are supposed to be pretty rough up here. So hang in there, everyone in this area. Wildfire season is pretty brutal. Makes the air rough. No hiking, which is kind of the worst. But hey, it's temporary. Fingers crossed, so we'll get through it. In the meantime, hope you guys are all doing well and having a great Monday after a good weekend. S&P closing almost precisely at 7,600. I did see some comments celebrating that push to new all-time highs. We didn't quite get to a new all-time high today. I will tell you, if on Monday, or sorry, if at some point we get above 8,000, I do have the trumpet right there. I will be happy to play something else. When we broke above 7,000, I did a random fanfare that I remember playing Take Five by Dave Brubeck. So I'll start working up some alternatives to whatever 8,000 will be. If you have any suggestions, drop a comment, let me know. In the meantime, let's use our time today focusing on what happened in the markets. It was a pretty strong day across the board for risk assets. Not as good for metals, not as good for energy because crude oil price is coming back down because all is clear in the Middle East, as far as the latest headlines would tell us. Still expecting lots of volatility there, but for now, coming out of the weekend, the market's going full on risk on here. The question now is, do we have enough momentum to get above the upper edge of this consolidation phase we've been in for the last 10 plus weeks now? We're going back to mid-May is when we first got up into kind of this range, kind of between 73, 7,600. And we're still there as of today's close. We'll talk about some of those charts and more, but let's first check in on what happened in the major markets. So the S&P up 1.5%, closing just above 7,600. The Nasdaq Composite up 2.1%. That's your best performer on the front page. Don't count out mid caps and small caps. All finished near the highs of the day. The S&P Small Cap 600 Index actually outperformed the large cap S&P 600. So large cap growth was pretty good, but small caps are pretty good across the board as well. So S&P 600 up 1.7%. The VIX moving back lower, actually below 16. So that basically means that the options market are pricing in less than 1% as an average daily move on the S&P is kind of what that means. So low volatility, uptrend, strong, move from, literally the end of the press conference, pretty much the end of the day last Wednesday through today. It's been 3 straight kind of rock star higher closes to move the S&P from almost 7,300, the lower end of our range, to almost 7,600, or at 7,600 at the upper end of the range. That's how quickly this market has reversed. Will it have the momentum to get through and go to new highs through the course of this week? I would say still an open question, but pretty encouraging start to the week for sure. Rates generally moving lower today. The 10-year yield now back down below 4.7%. The long bond yield still around 5.25%. The short-term yield is actually pushed up a little bit today, so slight flattening of the yield curve here today. Rates have generally been moving higher, and bonds did sell off through the course of the day. 10-year yield still kind of in the upper end of the range that we've been in now for a couple months. Worth certainly keeping an eye on through the course of the week. The dollar ETF that we track, UUP, was essentially unchanged today. The dollar index turning a bit higher today. All right, looking at the commodity space, gold and silver in the green, but not by much. I would say gold still in a primary downtrend. We're still making lower lows and lower highs. We'll look at the chart of the GLD together, just kind of focus in on, what levels would complete a potential rotation into more of a bullish phase. But for now, still waiting for that to be completed. Copper prices were pretty good today. Crude oil and Brent crude both coming down. Of course, the headlines going into the weekend were pretty negative, talking about a major U.S. strike in Iran potentially by Sunday. And I feel like this has been the weekend routine for I don't know how many weekends. It's been sort of really aggressive going into the weekend, usually after the markets close. I don't think that's a coincidence. And then Sunday, just before the markets are opening, we're talking about how things are great again and things are fine. So it's sort of focusing our negative energy during the weekend when the markets are closed. And sure enough, we opened Monday with weaker crude oil. So crude oil price is down 5.5%. Crude oil future, which is the main U.S. benchmark, almost right at $80 a barrel. And that $80 a barrel level is the one we've been focusing on now for quite some time here as a key pivot point. Right above 80, I would say is a problem. Below 80 is kind of a no problem. And so that's we're sort of right at that point. As we've mentioned, just given the volatility of the headlines, we're expecting serious volatility in crude oil and energy prices, certainly volatility in the energy sector. And today is just the latest data point completely validating that as a reasonable thesis right about now. Kind of mixed results in the soft commodities. We're noting corn and wheat having a pretty good day. Corn surging higher in the afternoon, as did wheat prices. Both ended up about 2% higher for the day. Looking at cryptocurrencies, kind of mixed today. Over the weekend, Bitcoin was sort of in the 62 to 64,000 range, currently trading just below 64,000. That's just up slightly from the end of the day on Sunday, and Ether price is just slightly lower. Both sort of right around the levels that we were talking about going into the weekend. Not a huge change, I would say, in any of those charts just yet. Looking at the 11 S&P sectors, 8 out of the 11 in the green, so pretty good day in terms of sector performance. The XLC at the top of the list, you've got some pretty compelling charts in the communication services sector. The two big ones, of course, are Alphabet and Meta. Alphabet, gapping higher on earnings and just kind of pushing to the upside. Meta actually gapped down on earnings, but pushing higher off of those lows. And I grabbed the chart of Meta just to show you what I mean. When you have a gap down on earnings, right, the question is, after that gap, do you see buyers coming in and buying on that revaluation to the downside? The chart of Meta telling you that's exactly what's happening. We're getting buyers coming in on the major lows and pushing the price back to the upside. XLI, the industrial sector, and XLY, the consumer discretionary, both up about 1.8%. On the downside, the energy sector, the worst performer day on weaker crude oil prices, down 1.3%. Healthcare and consumer staples, which are two of the defensive sectors, basically slightly lower. And you can see that the four out of the five weakest sectors were all the defensive ones. So we're definitely getting a out of defense into offense vibe. End of last week into this week. That's been the last three sessions have very much been about that. Looking at the breadth data, pretty good breadth actually today, right? So you have the major averages moving higher. You've got large cap growth leading, but you also have improving breadth. And that's something we didn't see a lot in recent weeks. You'd sort of seen, tech up, mega cap growth up, but then breadth lower, or tech down, and all the breadth surges as all the other sectors start to do well. This is sort of like a generally things going well kind of day. Now, again, besides energy and besides kind of flat action in the defensive sectors, the growthier stuff and the other cyclical sectors like industrials did quite well today. So the breadth pretty good, about a 2-to-1 ratio on the New York Stock Exchange, 68% higher in the small cap index, and almost a 4-to-1 ratio, 79% advancers to 21% decliners. Pretty good action there. Our market trend model, as we told our premium members over the weekend in our weekly flight plan, that's our main investment report that we produce every weekend. And if any of you want access to that, you just have to become a premium member. Go to marketmisbehavior.com/premium for more info on all the great benefits of the premium membership. And we often focus our attention every week, starting with our market trend model. Went back to bullish on all time frames, which basically tells me, until further notice, focus more on capital growth than capital preservation. That's what I'm going to be doing. Here are the 9 Morningstar style boxes. You can see large cap growth, the best performer, but also note that small cap pretty strong across the board, from value to growth and everything in between. The small cap indexes generally did pretty well today. So outperformance of small caps seems to be a thing that I think we don't want to ignore. All right, looking at the Dave's Dirty Dozen, these key growth stocks to follow, we can see Meta moving higher, 6%, SpaceX up 5.7%, Microsoft, Alphabet, Amazon all up over 4.5%. So obviously mega cap growth having a pretty strong day all around. Meta and Alphabet, of course, both in the XLC, the communication services sector. You've got Microsoft is up 5%. And then SpaceX actually having a decent update. Is the chart of SpaceX in anything but a downtrend at this point? I would say no. It is pretty clearly still making lower lows and lower highs, but hey, we've got to start somewhere. Maybe this is the beginning of the first big move higher in SpaceX. For what it's worth, moving higher in complement to the other names. Tell you one key growth name that did not participate in today's upward surge. Apple, which was actually down 1.8%. What's so fascinating is into last Wednesday, Apple made a new intraday all-time high. Thursday gapped lower a little bit. Friday, big gap down. Today, rotating lower yet again and closing near the lows of the day. So Apple kind of, maybe surprisingly, had been, I would say without argument, the best chart of this basket through last Wednesday and maybe even through last Thursday. But Friday and now into Monday, Apple kind of going risk off. And that's noticeable when the rest of these stocks are doing so remarkably well today. All right, we're going to go to the heat map and talk about some takeaways at the group and sector level. Do want to remind you we're going live at the moment on Facebook, YouTube, and X. Thank you guys so much. Those that are tuning in live, you are welcome to ask questions as we go. We'll do our best to grab a question or two through the remainder of the discussion. Any of the questions we don't get to, we'll put them in the mailbag. We had a fun mailbag episode on Friday featuring some of your questions from last week. So please make sure you check that out if you didn't do so already. And if you're watching later on our YouTube channel, just use the comment section on our YouTube channel. We filter through those every day, looking for great questions to throw into the mailbag. So thanks so much for asking questions and making the show pretty interesting to put together every day. All right, looking at the heat map here today, I mean, obviously a lot of green and a lot of key big growth names, and we can see NVIDIA and Microsoft in the upper left, two of the biggest names in the technology sector, obviously doing pretty well, as I mentioned. Apple kind of a downside outlier, not participating in today's rally. Also noting the storage names, Seagate and Western Digital, not down a ton, about 3% each. But again, on a day like today, when it felt like a big up growth day, the days that didn't participate, or the stocks that didn't participate, kind of stand out to me. So I think worth noting there. Wasn't a huge day for semiconductors, to be honest with you, generally. There are random ones that had pretty good days, but you can see like Lam Research up 0.5%. So this wasn't like a big upward surge. Broadcom and Micron were up less than 1%. So, not down, I mean, and up, but, I would say Micron just over the last, the last month continues to pull back, right? Micron doesn't look like an exceptional chart at the moment. So the chip makers kind of holding pattern, I would say, while some of these other growth sectors start to do better, particularly some of the mega cap growth stocks. Other thing I would say would be Alphabet and Meta, obviously the two biggest names in the XLC, having a pretty good day. Amazon and Tesla. So you can see like a couple of the biggest names in each of those growth sectors just had really strong days, and that's what's really making this certainly making the benchmark surge higher. So that I think is a key part of the story. Other things to note, right? Outside of the growthy sectors, it wasn't all bad. And I would say there's some things that did pretty well. And particularly in the industrial sector, we're noting Bank of America getting to the upper end of the range that we've been in for the last 3 months. Eaton Corp actually reversed after Thursday and Friday, kind of making a new 3-month low, completely flipped. And today made a new 3-month high. So again, even though the VIX is low, I can't stress enough, the volatility of individual names seems way higher than the VIX. It almost feels like the VIX is artificially low for some reason. And there may be some great reason why that's the case. Maybe it's something about, zero DTE options are impacting it, or maybe it's just, it's looking at S&P index options, which are less, showing less volatility than other areas. But, the individual stock volatility by my read looks incredibly strong and incredibly high. So you'd think the VIX was a lot higher. I think it's surprising as to how low it is, given the swings we're seeing. Like the chart of Eaton Corp, I think is just a great example of that. I mean, right, looking in 3 days, we went from closing below the 200-day to just whipping around and going higher. And how many stocks have had this like big surge higher, or some like Marriott, which I'll show you in a little bit. I mean, just rolling over and dropping. So it's a big movement kind of time here. So I would say, again, in the industrial sector, a number of things actually looking pretty interesting. Some things that had been pulling back last week are actually starting to rotate higher pretty aggressively. Not all great in the financial sector, but a number of things kind of making new swing highs. Some of the larger names in the financial sector were kind of neutral today, not big movers. But BlackRock, I meant to grab and I didn't, so I'll just show you very briefly. I mean, it's kind of a classic breakout pattern. We broke above the 200-day. We pull back to test the 200-day. We're breaking above there now. The previous high was 1100 from May, and we're closing back above there today. So I mean, it seems like a nice sort of upside rotation. The financial sector generally showing some pretty compelling charts for sure. So financials not really losing a lot of steam today. And again, with some particular names, COF, I think is one I grabbed. I forget, but that's one that made a new 3-month high today as well. My mind's a little cluttered because I just a little earlier before lunch for me put together the top 10 charts to watch for August. That's with the editor at Stock Charts to go on the Stock Charts TV YouTube channel. Hopefully that'll be posted later today or maybe first thing tomorrow morning. We keep your eye peeled for that. I do a weekly show on Stock Charts TV every Monday. And this time highlighted 10 stocks that I think are pretty important to watch. COF was one of those from the financial sector, which is why that ticker kind of jumped out for me. Other things to note, of course, the energy sector struggling. As long as the crude oil prices are pulling back, these names are most likely not going to continue the uptrend phase that we've seen. Charts like Exxon and Chevron have had a pretty good run and had a pretty strong July as crude oil prices sort of bubbled higher. Now it's sort of an open question as to whether those will continue. A number of the names that are more like the retail names like Valero and PSX, Phillips 66, are all right at new all-time highs. They sort of got up there earlier in July and still remaining right around that level. And those are ones that are a little less sensitive to crude oil prices. They actually do fine even if crude oil prices are down. Elsewhere, I would say the defensive sectors, generally not the leadership. And so I would say within consumer staples, utilities, real estate, I'm kind of thinking of those as a cluster of sectors that did not do remarkably well here today. And then in the healthcare sector, actually kind of mixed. And healthcare as a sector has actually looked pretty good. It's actually had pretty good relative performance through the end of July. And I would say today, a bit of a mean reversion. So the names that actually did well are charts like ISRG, Boston Scientific, BSX. These have been some of the weaker charts in the healthcare sector. On the other hand, you had names like Eli Lilly coming off of a new all-time high, AbbVie, which made a new all-time high last week, all kind of coming down. So, for me, what are the interesting charts? Like Stryker is one, SYK, that comes to mind. These are charts that are more sort of rounding higher, that made a low earlier this year, continue to make higher highs and higher lows. That's where I would probably focus my attention there. All right, I see some great questions coming in. Keep them coming, please. And you're welcome to drop them in if you're watching live. If you're watching the show later on our YouTube channel, just use the comment section. Do want to let you know as I'm going to some of the charts that we've grabbed for you. Latest episode of the Market Misbehavior podcast went live first thing this morning. Mary Ellen McGonigal, longtime Stock Charts contributor, someone whose work I have followed and trusted for a long time. Consider Mary Ellen a friend. It's been fun to collaborate her through our time, both being Stock Charts contributors. We had a really fun conversation at the end of last week, talking about process, talking about routines. Mary Ellen is someone, if you didn't know, worked directly with William O'Neill. I mean, one of the legendary, investing educators and authors, and really applies, I would say, her own unique spin on the O'Neill methodology. So it was a really cool conversation about just stock picking and positioning and how to think about idea generation, but also some observations about the current market environment, seasonality, et cetera, et cetera. You can find that on our YouTube channel, or of course, anywhere you get your audio podcast will be on there as well. All right, daily chart of the S&P. I mean, so here's the thing, right? Great day, hands down, awesome day. Third day straight of closing near the highs of the day, and I think that's important. Are we still within the trading range? I think we are. The price is literally at 7,600. That's the pink shaded or purple shaded area that we've been highlighting now for a couple months. The RSI is right at 60. I mean, we're right at that point where this looks like a pretty good breakout, but it does need to happen. So a breakout, some follow through would be pretty meaningful. And I'll take a question here real quick because I saw this pop in earlier. We've talked about follow through days being the following day after a pop up or down. Can a follow through day be 2 or 3 days after? That's actually a really good question. And so I would say with any sort of like patterns like that or breakout, there's sort of like the ideal pattern, right? Like if I was writing a book on technical analysis, like the chart I would include is like here's the ideal situation. And I would say the ideal situation would be you have a big move higher, you have follow through the next day, which implies that that move that we saw on day one wasn't just a fluke. There's additional accumulation coming in. And I would say that's a really important factor, a really important technique or a concept to make sure that you think about, particularly if you use charts, because it can be way too easy to see an initial move and just sort of bet, all right, that's the breakout. And a lot of times you see that like on an intraday basis, we'll start to break above resistance. People get all excited, but then we close near the lows, right? Or we close higher, but then the next day we sell right back off. And it happens so much that as a technical analyst, you learn to wait for that follow through, because the absence of a follow through can be really dangerous. Now, your question is there a situation where we break out, maybe we dribble lower a little bit and then kind of move higher? Like, yeah, would that be the ideal situation? Like, no, but would it still demonstrate a nice period of accumulation? I would say so, right? And all that means is we had the breakout, we had the doubters, but then we have dip buyers coming in, and that can provide a great, a great sort of signal. So, again, that general concept for me is the ideal situation would be the next day sort of indicates new follow through. Would it be less perfect but still pretty good if we pulled back a little bit but then made a new high? Yeah, I just think that would probably make a higher low and show you that dip buyers are coming in. And then I would also say this is why looking at things like the momentum, looking at the RSI can be really good to sort of corroborate the move that you see in terms of price. And maybe that can help you differentiate whether it's a good follow through move or not. But really, really good question, by the way. And thanks for that. So chart of the S&P, I would say, very, very close to a strong price breakout on strong momentum. Not quite there, pretty close with today's rally. And certainly that's top of mind as we continue through this week. And again, what's so funny is it's like there's so much that could move the market in either direction just in the next couple days, between headlines from the Middle East that are clearly still quite volatile. And even from 1 hour to the next, the headlines seem severely different. And so we just have to wait and see how things play out. Obviously, tons of earnings, right? So we're in the middle with Palantir and a button NVIDIA and a bunch of other companies. A big percentage of the S&P reporting earnings this week. So that there's a lot that can happen there as well. Economic data, et cetera, et cetera. So a lot still to digest. Other charts to talk about. The breadth remains still pretty good, right? And I think that's one of the key things that I keep coming back to. When you see the S&P range bound now at the upper end of the range, wondering if we're going to break out, what are the things that would help us confirm that this is a healthy breakout and not a fake breakout that we probably want to be fading? I would say the breadth remaining strong would be one of those things that would clearly check the healthy breakout kind of thing. The advanced decline lines are all trending higher. None of them made a new high today, I don't believe, but are they still above the upward sloping 50-day? They are. I would say this chart could become pretty crucial, though, because if the S&P does move above 7,600 through the course of this week, if that's not confirmed by breakout in the advanced decline data, that would be a concern for me. But for now, still looking pretty good. Volatility still remaining very low, and I think that's important to watch as well, right? The VIX is down around 16. Again, even though the volatility we're seeing on the individual stocks is significant, and I think that is not reflected by the low level of the VIX. But again, if you look at long-term market history, major sell-offs usually don't happen unless the VIX starts to spike a lot higher, right? When the VIX is about up around 20, which is why last Wednesday we're talking about, look, volatility is starting to increase. We start to break down through support. We break down through 7,300. I could see a scenario where this starts to really deteriorate. We didn't get it, right? We never stayed above 20. We came right back down lower Friday, lower again today. So VIX around 16 is a low volatility environment. That just tells you the options market's not pricing in a high risk of big movements at this particular moment. Now that can change very quickly, but for now, VIX around 16 is pretty constructive level to be at. So what's so interesting is the correlation between stocks and gold has been, generally high at certain points in history, but it's really not been that good here recently. Now, gold isn't going down anymore, as I mentioned on recent episodes. Gold's really going sideways, and this is the GLD that we're looking at here. So we're not making new lows. We're just not really breaking out anymore. So similar to the S&P being in a range, gold's being in a range as well. Really goes back to kind of mid-June. But from mid-June really through the end of July, now early August, we're sort of in this consolidation phase. And I would say on this chart, no real clear indication whether we break up from here or break down. This tells me to just wait and see and be patient and wait for that sign. But we're pretty close from breaking to the upside above that trend line, and certainly above the 50-day moving average could indicate a new uptrend phase. And gold has been a sleepy, quiet, bearish momentum chart for a while. Look how long the VIX has been generally below 50, and that just tells you the strength of this consistent downtrend going lower. So again, we're not making new lows yet, but we're really just sort of stalled out in a sideways pattern. This is a great chart to watch to look for that breakout higher. We just haven't had it yet, and I have an alert set for around 385 on the GLD, and that's, I think, the key level to watch. I think I do, but I'm going to write down to make sure that I have that alert set. Offense over defense. One of the big shifts we've observed now from the end of July, now going into the beginning of August, is a pretty quick reversal in indicators that look at offensive sectors versus defensive sectors. Here we're looking at the XLY versus the XLP. That, of course, has popped up quite a bit primarily because like Amazon and Tesla both kind of rotating higher off of those of the lows for Tesla, but Amazon kind of drifting up as well. The equal weighted version there, which kind of takes the Amazon and Tesla overweight out of the picture, also trending higher over the last week and a half. And so I would say one of the more encouraging rotations we're seeing is offense starting to really outperform. This is something we've not seen in a while. So as the S&P has been consolidating, we really haven't seen a big improvement in relative performance and in relative performance of offense versus defense. I think this is a key chart to watch. And again, when you think about what would give you confidence as the S&P is breaking above 7,600 that it's a good breakout and not a bad breakout? A good breakout, I would argue, most likely has to be supported by this ratio kind of breaking out as well, right? You need offensive sectors leading and not defensive sectors. That's usually the sign of a much stronger market environment. One of the ways to think about that idea of offense versus defense, I'm illustrating on this chart here. Now, on the bottom panel, we're looking at the S&P 500. In the top panel, I'm basically looking at the relative performance of the S&P 500 versus the utilities sector. So the other way to think about this is I'm taking the relative performance of utilities and inverting that series. So if this ratio is going up, that means utilities are underperforming. That's usually a bullish market environment. We can see coming off of the March lows through April and May, look at how that ratio went up pretty good because utilities were underperforming, or in the way that this chart is representing it, the S&P outperformed the utilities sector. But as the S&P has been sideways, look at how the relative performance of the S&P, we've underperformed the utilities sector. So that downturn in this ratio kind of aligns with the sideways market action, right? Defensive sectors like utilities have just been looking way too strong. Now we're actually starting to see utilities and other defensive starting to underperform, which means this ratio is going up, which is a pretty good sign that the S&P has the momentum, or at least the support in terms of sector leadership to really have some further upside. So this ratio continue to go higher, or again, to rephrase, utilities underperforming, defensive sectors underperforming. One of the key things we look for to validate a new breakout. That's a good chart to watch for now, starting to really break out a little bit. All right, we'll finish off talking about some individual names. Alphabet closing above the trend line. We've been talking about this trend line for how long, right? I'm going back to, sort of July. We talked about these, the rally, and almost looked like an inverted head and shoulders. Didn't end up being really that type of pattern. But I would say really impressive how Alphabet, after gapping lower third week in July, stay below the 200-day moving average for just 2 sessions, regained the 200-day, and then started to accelerate higher on Friday. And now again today, finally getting above that trend line that we've been drawing. I had an alert set, excuse me, for when Alphabet closed above 370. We got that alert earlier today. Now, follow through, concept we were asked about earlier. That's what we look for. After you have a big breakout day, do you get follow through the next day, right? Do you see additional buyers pushing the price above those previous swing highs? I think it's worth noting Alphabet breaking out, RSI pushing above 60. That's pretty good. Let's see if we get follow through. Western Digital and Seagate, the two storage names, I would say noticeably not participating in this broader advance from mega cap growth today. A lot of the semiconductors weren't necessarily as strong as you might expect, given the fact that the S&P and the NASDAQ rallied the way that they did. Still watching the 50-day moving average, still watching this 38.2% level. I think Alphabet above 590 or excuse me, Western Digital, that is above 590 is probably a pretty good chart again. I'm going to make sure I have that alert set as well. But until then, I would say on the tactical time frame, kind of holding steady, kind of neutral. RSI right at 50. So the storage name's kind of still holding in a consolidation pattern. Coinbase is a really interesting one. Earlier in the day, it was up here, and it would have been what we call a bullish piercing line candle. It didn't end up that way. So friendly reminder, during the trading day, candle patterns can look a certain way. By the close, they can change dramatically. And so from the time that I saw this chart 5 hours ago or something like that to the time I'm actually looking at it now, you can see that it's no longer a bullish piercing line because the market came lower, and now it's no longer that same pattern. It's not really a candle pattern to speak of at this point, but I would say Coinbase pretty interestingly testing a key level of support. That 140, 145 level has been support all the way back to spring of 2025, and now a number of times through 2026, all testing that same level. Is this a retest of major support? Is this the opportunity to ride a chart like Coinbase back to sort of re-enter this range from before? To be determined, but I would say it's worth noting, certainly as a contrarian, this is the type of chart I might be looking for. An interesting one. And what you want to see from Coinbase is what we're seeing in the last week from Meta, right? Meta gapped lower last week. And if you remember, that same day, you had Microsoft gapping up, Meta gapping down. It was like the tale of two charts. But then look what happened after the gap lower. Stock traded at the highs of the day last Thursday. Here's Friday continuing to go higher. And then today, just accelerating to the upside. So Meta missed earnings. Is that good or bad? Well, on the surface, on the initial read, that's pretty bad, right? And that's why the stock gapped lower from 585 to 525 from one close to the next. Thursday, we open around 525. But then look at the intraday sentiment where every day we're seeing buyers come in. So the fact is we gapped down to key support, right? That was the March low. So when we gap down to a key level of support, this is where I would argue a lot of times you have this pattern where the gap is met by a bunch of investors that are thrilled to buy in on that short-term weakness. Instead of thinking of, was this quarterly earnings report good or bad? It's pretty bad, but does this give me an opportunity to buy into a pretty good company that we just got, $60 off? And that's kind of what investors have been doing since last Wednesday's close, buying into the weakness on Thursday and Friday and again today. Is this a great chart yet? No, right? I mean, a great chart for me is in an uptrend of higher highs and higher lows. I still think this chart has quite a bit to prove, but is it demonstrating the fact that buyers are coming in as we retest those March lows? I think absolutely. So what would we need to see to get more excited about it? We're right around a cluster of moving averages, which I'd love to see it regain the momentum. I'd love to see it get a lot more positive, but for now, initial rally off the lows is pretty good. Not everything good here, and I would say Marriott surprising to the downside today. They're actually an earnings name today. So again, this is what to watch for. Even though earnings season generally has been pretty good, there are plenty of stocks out there missing earnings or downgrading their guidance, underwhelming expectations, and as a result, the stock getting dinged. Marriott looked really good into mid-June. By mid-late July, the stock has been pulling back quite a bit, sort of languishing at or just slightly below the 50-day moving average. So today, it appears to be, making a new swing low. We're kind of testing the lows from May. The fact that we have the breakdown on much weaker momentum, I think a chart like Marriott, the one I would probably avoid until some sort of improvement. Looking for stocks making new 3-month highs earlier today. DoorDash came on my radar actually last week because we got above the 200-day moving average. And I like the fact that we're continuing to kind of push higher. So I would say this pullback to the 50-day, the push higher, getting back above the 200-day, pretty nice follow through on DoorDash. So there are stocks out there that are not overextended, starting to turn higher after a pullback previously. Those are some of the names I'm kind of looking for. Wow, we had a bunch of questions. I can't get to all of them, but let me look through a number of things here. There were a number of questions I was trying to grab when I could. Yeah, great comment on gold, right angle triangle. Thanks for watching. So gold's problem, number you were talking about gold. Gold's problem is its competition with yield products like treasuries, especially when it exceeds 5% in the long end. 100% right? If you think about if you're diversifying away from equities, away from the AI trade or something like that, where do you go? And the problem is when rates are getting as high as they are. I mean, the 10-year yield has been just steadily going higher. It's, I mean, still around 4.75% to 5%. I mean, that's not a bad yield, right? And one of my recent interviews on the Market Misbehavior podcast, this was actually last week, with Joanne Bianco of Bond Blocks. We talked about, sort of active management in the fixed income space, thinking of bonds as offense as opposed to defense. She had some specific thoughts about particular plays to make. I encourage you to listen to that interview. But, that was the thought, was like, it said like gold isn't really giving you much in terms of income. It's certainly not giving you much in terms of returns in 2026. Bonds pretty compelling. While the returns have not been particularly good, the yields pretty decent. And so I think that's a very fair point. Also for defensive sectors, right? I mean, if defensive sectors are not going to pay as much as a bond yield, bonds are a much safer bet than buying a high yielding name. So that, I think that's an important theme certainly to observe here. Yeah. What news sources do you use to get breaking geopolitical or other news that immediately moves the market? Great question. So it's all about access. And the good news is, as an individual investor, for those of you that are, for like a financial advisor that doesn't have the resources of a huge firm, I mean, at like at a Fidelity where I'm working, like we have real time, we have a fire hose of real time, urgent stuff. And we also have a trading desk where you'd have that they would be talking to everyone, like they would know everything. I mean, they would send alerts like something's going on. And then everyone else would have like less and less access. That gap, I mean, there used to be a huge knowledge gap and an information gap from big firms that just had the access to individual investors, which were like, in no man's land with no great access. The internet's changed all of that, I would say. And so the gap between what an institution can get and the gap, to what you can get as an individual investor, it's not, I mean, it used to be huge. It's pretty narrow. I would say the advantage you still have is access to a bunch of really smart, well-connected people that just kind of know things and have good educated guests to share. And that is still an advantage for sure. But in terms of the raw data and news flow, I mean, if you watch X, you're going to get some pretty good alerts on things. So that is a long-winded way of saying I don't think it's as bad as some of you. I mean, some might think, well, we don't get as good of information. I think actually, as an individual investor, we get great information. And the gap is a lot smaller. So what do I use personally? So I have 3 monitors in my office. I have a laptop, which is where I do most of my work. I have a monitor right in front of me, just below this camera, where I literally just have a chart up at all times. And I'm just going through charts all the time. That's how charty my life is. And then I have this monitor on the left where I'm using, different AI bots. I'm looking at news. I have some other market data platforms. And then when I'm streaming, I'm using, stuff over here on my left. But the tabs that I have open at all times, the Wall Street Journal, and that's really not for cutting news, but that's more just for like, general thinking and opinion, because a lot of that is sort of taking news, but applying it with an investor approach, which I find helpful. Investors Business Daily, which again is more thoughtful content and less, real-time stuff, Seeking Alpha. But then the 2 that are more news-oriented, Bloomberg and CNBC, and those are the 2 that I have as go-tos. Other times when I'm trying to figure out something that's going on, honestly, X is where I use and using, people that I follow there that I think are pretty well connected and tend to get things out pretty quick. I mean, you're not missing much if you're watching, X and looking for breaking news. I think it's pretty helpful. There we go. What else? But I would say in terms of like the institutions, Bloomberg for me I got my start in the industry there and really understood the idea of breaking news and how it works. And I'm a huge believer in what they do. So I subscribe there and I use CNBC as well, for sure. There's one other comment, and if I can't find it, I'll probably just find it later and put it. Oh, it was something about seasonality. Yeah. What is the historical outlook for the month of August? Thanks for watching. And actually, by the way, later today, I'm going to be doing my monthly chart review for our premium members, and we will talk a bit about seasonality. But as a quick comment, so here's the thing: seasonality is not great in August and September, and this is looking at the last 20 years. So and this is kind of hard to see, but I can zoom in a little bit, right? These numbers, if you can see, these are the average returns for every August going back 20 years. Here's the average returns for every September going back 20 years. September is the only month out of the 12 that has a negative average return for the last 20 years, right? Say that again. It's the only one of the 11 sectors, 11, it's the 12 months, that is, sorry. It's the only one of the 12 months that has a negative average return. If you go back for the last 20 years, just look at the average returns for that month. So September is usually pretty bad. August is not as bad, but is definitely one of the worst months as well. So the August, September 2-month period is one of the worst. Now, you have to remember that's going into October and then November. And November tends to be the strongest month of the 12 because you usually have a major low in the fall. And then this is when you recover and things are usually pretty good going into the holidays. That's like the general playbook for the markets. Now we can also look at midterm election years. Sorry, there's a manual process. But when we look at midterm election years, so we're just looking at 22, 2018, 2014, et cetera. You can actually see August and September, one of the worst 2-month stretches, May and June, which is actually pretty interesting because, the market was pretty strong April and May, and then June was when we kind of stalled out and went sideways. July is actually consistently one of the strongest months going back during pre-election years. And November has been up 100% of the time in a midterm election year going back for the last 5 cycles. So short answer is August and September, usually not pretty good. That is a problem. Does that tell me to get defensive just because it's August? For sure. And I mean, absolutely, absolutely not is what I might say. Absolutely not. Just because the seasonal tendencies tell you what usually happens, at the end of the day, trend is most important. And so I think watching the chart of the S&P is by far more important. However, understanding those seasonal tendencies, certainly valuable. Folks, that'll do it for today. Thanks so much for watching the show today. We'll be back tomorrow with a live episode at 5 p.m. Eastern, 2 p.m. Pacific. Hang in there. Those of you in my area of the country dealing with some serious wildfire damage and a lot of smoke, hang in there. This too shall pass. Have a great night. And remember, it's always a good time to own good charts. Take good care, folks.